Now, we all know your school textbooks told the story like this. America wins the war, rebuilds Europe, and asks for nothing in return. The Marshall Plan, Bretton Woods, the World Bank, all instruments of unprecedented generosity from a nation that wanted only peace and prosperity for its former enemies. 60 million people died, and America emerged as the benevolent superpower. Indeed, that is the version the mainstream wants you to know, but it is incomplete. Now, our last episode traced how a secret meeting at Jekyll Island in 1910 produced the Federal Reserve, a central bank designed by the very banking families who would profit from it. But when the Great Depression hit, those families did not suffer. They consolidated. Senator Aldrich's son, Winthrop, took control of Chase Bank, while Morgan Partners acquired distressed properties across multiple sectors. 9,000 banks failed, but the architects of the system emerged wealthier than before. In today's episode of The Finance Friar, that pattern is about to repeat, and this time the stakes are control of global finance itself. By the summer of 1944, Nazi Germany was collapsing, but the post-war order was not yet written. The British Empire was financially exhausted after years of war, its treasury drained, its global position weakened beyond repair. The United States, by contrast, was the great creditor nation, its factories humming, its treasury overflowing with gold. Much of the Allied war effort had been paid for in bullion shipped across the Atlantic, and by the mid-1940s, the United States controlled somewhere between 2/3 and 3/4 of the world's official monetary gold reserves. Into this imbalance stepped the Bretton Woods Conference, formerly called the United Nations Monetary and Financial Conference. From July 1st to July 22nd, 1944, 730 delegates from 44 Allied nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire, to design the post-war international monetary system. It has been described as the moment when the American economic empire, the empire of the dollar, was born, and when a decisive financial strike signaled the irreversible decline of Britain as the world's financial center. At the center of the American delegation stood Henry Morgenthau Jr., Franklin Roosevelt's Secretary of the Treasury. Morgenthau served as president of the conference and oversaw the negotiations that produced the new architecture. Under his chairmanship, the delegates agreed to a framework that would lock in American financial leadership, stabilize exchange rates under American terms, and channel Reconstruction through institutions the United States could effectively dominate. The official communiques emphasized cooperation and stability, but beneath the rhetoric, the structure was clear. The United States would provide the anchor, its dollar, backed by its massive gold hoard, and the rest of the world would orbit around it. The delegates agreed to create two new institutions. The International Monetary Fund would monitor exchange rates and lend reserve currencies to countries with balance of payments problems. The International Bank for Reconstruction and Development, the core of what is now called the World Bank Group, would finance post-war reconstruction and longer-term development. The mechanics were simple but powerful. Each country declared a fixed parity between its currency and the American dollar, agreeing to keep their currencies pegged within a narrow band of about 1% around that fixed parity. The United States committed to convert official foreign dollar holdings into gold at $35 per ounce upon request, but only central banks, not private citizens, were allowed to make this exchange. In effect, gold remained the ultimate settlement asset, but the dollar became as good as gold in international transactions. Other countries held dollars as their primary reserve asset, both because they were needed for trade and because American gold reserves looked overwhelming compared to everyone else's. On July 23, 1944, following the end of the conference and publication of the articles, the New York Times captured what had just happened. The American dollar thus obtains international recognition, on paper as in fact, as the world currency. The British economist John Maynard Keynes had arrived with an alternative, a more balanced scheme centred on a supranational currency he called the Bancor. The Americans, backed by their gold and industrial strength, rejected it. The British left with access to American credit and an acknowledgement that the pound sterling's era as the world's ruling currency was over. On the surface, Bretton Woods was about avoiding another Great Depression and the chaos of the interwar years. In practice, it locked in a system where the American dollar became the central unit of account, the key reserve asset and the reference point for global trade. The architecture was now in place, and the men chosen to run it came from familiar addresses. The cast from Jekyll Island included Aldrich, Morgan, Rockefeller and Vanderlip. Their descendants and protégés now reappear in the story of Bretton Woods and the post-war order. Consider Frank Vanderlip. Back in 1910, Vanderlip was president of National City Bank, today part of Citi, and one of the conspirators at Jekyll Island who helped draft the blueprint for the Federal Reserve. After World War I, as Europe lay devastated, Vanderlip and a network of colleagues working with bankers in Switzerland and Sweden proposed a massive privately financed reconstruction program for Europe, an early attempt to use organized private capital to reshape the continent's economy. The principle was familiar. Governments would bear the political risk, while private banks would provide the capital and reap the interest. In the first half of the 20th century, Wall Street power was often described as a contest between two houses, the House of Morgan, centered on J.P. Morgan and Company, and the Rockefeller Group, whose flagship commercial bank was Chase National Bank. The story of the post-war order is partly the story of how power shifted from one house to the other, and one man personifies that transition better than anyone. John J. McCloy. McCloy is the thread that stitches together war, Reconstruction, and Wall Street. He began his career in the Morgan orbit, mentored by Henry Stimson, the Morgan-connected attorney who became Secretary of War. McCloy's own family ties reached straight into J.P. Morgan. His brother-in-law, John Zinsser, sat on the Morgan board during the 1940s. But after World War II, as power shifted from old merchant banks to oil-rich, globally oriented conglomerates, McCloy gravitated toward the Rockefeller side of the street. During World War II, McCloy served as Assistant Secretary of War, involved in decisions ranging from internment policy to strategic bombing and occupation planning. After the war, his resume reads like a roadmap of the new order. President of the World Bank from 1947 to 1949, arriving just as it needed to prove it could borrow and lend on a large scale. United States High Commissioner for Germany from 1949 to 1952, where he oversaw the creation of a civilian government and laid the groundwork for the revival of German industry. Chairman of Chase National Bank and then Chase Manhattan Bank after returning from Germany in 1953. Chairman of the Council on Foreign Relations from 1954 to 1970, later handing the chairmanship to David Rockefeller, his ally at Chase. Advisor to every American president from Franklin Roosevelt to Ronald Reagan, earning him the label of the most influential private citizen in the United States. McCloy began as a Morgan-linked wartime lawyer and ended as a Rockefeller-aligned global banker. He personifies the continuity between the world of Jekyll Island and the world of Bretton Woods. Now, consider the Aldrich-Rockefeller line. From our first episode, you will remember Senator Nelson Aldrich, the Republican power broker who chaired the National Monetary Commission and shepherded the Aldrich Plan that became the blueprint for the Federal Reserve after being hammered out at Jekyll Island with partners from Morgan, Rockefeller, and Kuhn Loeb. That story continues through blood and marriage. Aldrich's son, Winthrop Aldrich, left law for banking and rose to become president of Chase National Bank from 1930 to 1934, then chairman from 1934 to 1953. Winthrop's sister, Abby Aldrich, married John D. Rockefeller Jr., making Winthrop the uncle of David Rockefeller. In 1946, David Rockefeller joined the staff of Chase National Bank, and at that moment, the bank's chairman, his direct boss, was his uncle Winthrop Aldrich. The same family that helped design the Federal Reserve in 1910 now sat atop the bank that would profit most from the post-war dollar system, and they wasted no time installing their own inside the new global machinery. The official story sells Bretton Woods as a triumph of multilateralism, but the personnel tell a more concentrated story. Henry Morgenthau Jr. served as Treasury Secretary and Conference President, using his wartime financial power to shape the post-war settlement. Harry Dexter White, the Treasury economist whose White plan largely prevailed over Keynes's Bancor proposal, embedded dollar centrality into the global system. John Maynard Keynes led the British delegation brilliantly, but negotiated from a position of weakness as Britain depended on American loans. And then there was John J. McCloy, brought in soon afterward to turn the World Bank from a paper institution into a real lender and borrower, bridging Washington's creation with Wall Street's capital. The World Bank's own historical account reveals something striking about how McCloy was recruited. He was approached by Eugene Meyer, the bank's first president, by Chester McLean, the bank's general counsel, and by Eugene Black. Eugene Black was then a vice president at Chase National Bank, and he would shortly become the American executive director at the World Bank and later bank president himself. The supposed public international institution was born with Chase's leadership wired into its structure from day one. McCloy immediately understood that if the bank was to matter, it needed Wall Street's trust. Under his leadership, the bank began borrowing heavily in capital markets, establishing its lending practices and internal procedures while cultivating relationships with major New York banks and investors to place large bond issues. The bank eventually sold hundreds of millions of dollars worth of bonds backed by the faith and credit of its member states, and it became a conduit. War-torn states on one side, bond investors and American commercial banks on the other. Consider the revolving door in motion. McCloy runs the World Bank. Eugene Black moves from Chase to the World Bank, eventually becoming its president. McCloy then returns to chair Chase itself. David Rockefeller is already there, working under his uncle Winthrop. The boundaries between public institution and private bank were porous, with the men who designed the global financial architecture in Washington moving seamlessly into the New York banks that would profit from it. And the banks that would profit from it had their executives positioned inside the architecture from the beginning. This was the New World Order, the dollar as king, the IMF as referee, the World Bank as lender, and at every critical node, the same network of bankers, lawyers, and family connections that had built the Federal Reserve 3 decades earlier. The greatest Reconstruction project in human history was about to begin, and Chase was first through the door. While the International Monetary Fund and World Bank were being set up, Chase National Bank was positioning itself to ride the wave of Reconstruction. Winthrop Aldrich was still at the helm. In the late 1940s, at the invitation of American military authorities, Chase stepped up its international expansion by opening branches in both Germany and Japan, joining its existing branches in London and Paris. The new offices initially served American occupation forces and related business, but they also placed Chase at the center of the coming boom in European and Asian trade. Chase's own corporate history later boasted that it had established the first American post-war bank branches in both Germany and Japan. Consider what that means. The same bank that had used the Great Depression to acquire competitors at fire sale prices was now first through the door in the defeated Axis economies, following the flag into the most lucrative Reconstruction markets on Earth. In 1955, Chase merged with the Bank of the Manhattan Company, and from that merger emerged Chase Manhattan Bank with a new driving force behind the bank's activities, David Rockefeller. Under his leadership, Chase spread internationally, building what contemporaries described as one of the world's most extensive networks of correspondent banks. The bank became a central player in global finance, using its far-flung branches and affiliate relationships to underwrite deals, arrange loans, and intermediate trade flows. By the late 1970s, a study of bank control over large corporations concluded that the Rockefeller-controlled Chase Manhattan Bank topped the list, exerting control over 16 major firms, a reflection of how financial power radiated outward through interlocking directorates and credit relationships. Running parallel to the World Bank's early operations was the Marshall Plan, officially called the European Recovery Program, launched in 1948. The United States transferred roughly $13 billion in economic aid to Western European countries between 1948 and 1951, equivalent to well over $100 billion in today's money. The aid was administered by the Economic Cooperation Administration under Paul Hoffman, who used the funds to restore industrial and agricultural production, stabilize currencies and public finances, rebuild infrastructure and energy systems, and encourage trade liberalization and economic integration. Official American accounts openly acknowledged that the Marshall Plan did more than help Europe. It created reliable markets for American goods, supported the development of trading partners, and anchored Western Europe firmly in the American-led economic sphere. The structure was elegant. Bretton Woods provided the monetary framework, a dollar-based system with the IMF and World Bank as institutional pillars. The Marshall Plan pumped in public funds to jumpstart recovery and trade. American banks, especially politically connected institutions like Chase, were perfectly placed to handle the resulting capital flows, underwriting, and trade finance. McCloy's position was unique throughout this period. As World Bank president, he had to define the bank's role in a world where the Marshall Plan was suddenly the larger, more visible vehicle for European aid. When he testified before the Senate Foreign Relations Committee about the plan, he supported it even though it risked making the bank look redundant, because it ultimately allowed the bank to shift toward its long-term role, financing bankable reconstruction and development projects. Soon afterward, as High Commissioner for Germany, McCloy oversaw the political and economic decisions that would determine which sectors of German industry were revived, which companies survived, and how rapidly West Germany re-entered global trade. Then, in 1953, he moved to Chase, taking his intimate knowledge of European reconstruction, German industry, and multilateral finance directly into one of the world's most aggressive international banks. The Great Depression had provided Chase with scale and resources. The World War provided Chase with global reach. The pattern from Jekyll Island repeated with precision: crisis, architecture, consolidation. Our first episode traced how the Panic of 1907 justified the creation of the Federal Reserve, a central bank drafted behind closed doors at Jekyll Island by a small group of politicians, bankers, and lawyers who then prospered under the very system they designed. The post-war story follows the same structure at a higher level. World War II left Europe in ruins, and the global monetary system shattered. At Bretton Woods, delegates codified a new order with the dollar as the central reserve currency and the IMF and World Bank as key institutions. America's extraordinary gold position and industrial dominance ensured that this system would revolve around Washington and Wall Street. The individuals and institutions at the center of this architecture were closely connected to the same family and banking networks that had shaped the Federal Reserve. Aldrich's lineage ran the bank. McCloy ran the World Bank, rebuilt Germany, then returned to chair Chase and the Council on Foreign Relations. Executives from Chase moved in and out of key roles at the World Bank and other Bretton Woods institutions. The Federal Reserve had stabilized a national credit system that benefited New York money center banks. The Bretton Woods system stabilized a global dollar system in which European and Japanese Reconstruction created enormous demand for dollar loans, trade finance, and bond underwriting. The Marshall Plan and World Bank projects effectively socialized the risk of Reconstruction, while private institutions captured a growing share of the ongoing business. The public story says America rebuilt the world out of generosity and vision, but the deeper through line is this. The same elite banking families and their legal and political networks that helped design the Federal Reserve in 1910 also shaped the post-war global financial system in 1944 and occupied the key positions to profit from the reconstruction of an entire continent. In our first episode, the setting was a private island off the coast of Georgia. In this sequel, it is a grand hotel in New Hampshire under wartime conditions. The cast, aged, and the scale expanded from national to global, but the script stayed the same: crisis, architecture, consolidation. The Bretton Woods Order made the dollar king, but it carried a built-in contradiction. The United States promised to redeem foreign central banks' dollars for gold at $35 per ounce, even as it poured dollars abroad through military spending, foreign aid, and private investment. By 1971, that promise would break when Richard Nixon closed the gold window, and the same families would engineer a new system to preserve dollar supremacy, this time centered not on gold, but on oil. Now we would like to see you in the comments. Before this video, had you made the connection between the Jekyll Island families and the Bretton Woods architects? We look forward to hearing your thoughts below, and thanks for joining us for another episode.